Hello, my name's Joe Walsh, Managing Director of ASX-listed Lepidico Limited. We're developing a vertically integrated lithium project based on a mine and concentrator in Namibia, shipping that mineral concentrate to a chemical plant in the UAE, in Abu Dhabi, where we're building our chemical conversion plant that employs our proprietary process technologies. Earlier this week, we made an announcement that we've just produced some extremely pure lithium hydroxide using our technology. And the independent group that produced that for us opined that it was the best quality material that they've seen versus conventional production. So I think we do stand apart from peers in the quality of the product that we can be producing. Thank you, Matt. I'm
Brendan Yurik, one of the founders and the CEO of ELEC Royalties. We're a mining royalty company focused exclusively on those clean energy metals really required for the transition to clean energy. Over 400 million has been raised in the last 18 months. That's all going into our portfolio. And so lots of exciting catalysts. We've got the second largest lithium royalty portfolio ever constructed. We've done, the first graphite royalty financing. And lots of catalysts to look forward to in 2023.
Hi, I'm Terry Lynch. I'm the CEO of Power Nickel, and Power Nickel is developing what I think will be Canada's next nickel sulfide mine, just south of James Bay in Quebec. We had a very successful drill program last year, and following it up with another program that's sort of, I guess we're a month into it now, another 2 months to go. We'll produce a updated 43-101 in Q1, and I suspect that'll put us pretty close to a commercial status. And I would say we're probably the cheapest nickel sulfide mine in the world right now. So
there we go, guys. I really appreciate the intros there. We've got ourselves a clean energy, green energy, battery metals panel here today. We're here actually to talk about contrarian investing, but I suspect we'll be leaning towards some of those topics specifically. But Joe, let's start with the macro. People are nervous. People are at risk of they're hoarding their cash rather than investing in equities. Are people right to be nervous right now?
Well, my view is it's the best time to invest is when the hordes are nervous. And that's where the best opportunities and the best returns come. And we've seen this before. If you look back over the last 15 years, there's been some of these huge dips that we've seen in the market, and they tend to happen fairly precipitously. And then the market bounces out of these, and it might take 6, 12, 18 months. But I would suggest that with where equity prices in particularly are at the moment, this is a great market if you've got the cash to be investing. And in the sort of new energy metals, in lithium in particular, what better place to be getting exposure, because the growth in demand in this space is truly unprecedented over the course of this decade and probably well through the next decade.
Well, that's the question I'm trying to ask myself. Is I thought we were meant to be at the beginning of some metals super cycle. It doesn't quite feel that way, does it, Brendan?
Well, I think it's short-sightedness, right? I mean, you look at how investors now are all about quarterly results. The funny thing about the mining sector is your average development timeline is 15 years. And so, on a fundamental basis, you can't really, find new supply. These are very rare metals. They're only located in very unique places around the world. And you can't print more of them, you can't mine more of them like you can in Bitcoins. It's just crazy. I think there's a big disconnect right now. Our portfolio is about 40% lithium. Lithium prices are over $7,500 a ton, just in the last couple of weeks. When we bought in, they were about $400 a ton, so our revenues, our forecasts are directly proportional to that increase. Yet we're sitting, where we were 2 years ago in terms of valuation. And so I think there's a very big disconnect right now. And I think you've already seen that fear hit valuations to the point where, private equity groups are going to come snap all this stuff up, all these companies here, before the retail guys even get a chance.
Well, yeah, well, that's another conversation we can have actually maybe later on, because I think that's really interesting. Because the public markets or public market companies are under so much pressure, and the cost of actually being public is slightly overwhelming in moments like this. Terry, kind of to that end, You've got yourself a nickel project. You've been kind of almost self-funding this thing. I mean, how easy is it for juniors in a rising price environment to actually raise money in a rather depressed equities environment?
Well, we're lucky that our management team and our core shareholders, have faith in the project. And I've sort of publicly said, hey, look, if we're going to give it away, we're going to buy it ourselves. That's sort of where we're at. So, we're backing up the truck now. We've just announced a $3 million deal. That's all basically being done with existing shareholders. And, thanks God we had that capability to do that. I think, nickel's one of those, especially nickel sulfides, not that expensive to develop in the overall scheme of things, So I mean, it's going to cost a couple $100 million. So maybe you need $75 million in equity. So it's feasible to see how this gets developed fairly, simply down the road. If you're into these multi-billion-dollar laterites, tougher, So I think investors got to pick their spots on these things. And I think the other thing investors should be looking for now's the time to get greedy, and you need to sort of think, hey, look at projects that I can get 10x, 20x, 30x. They're out there. 3 of them are on your screen. So it's like that's what's going to motivate you to get over your fear, because of course everyone's fearful. I mean, everyone's lost a bunch of money on paper. And they say, but I think that what gets you over the fear is, hey, putting it in the bank isn't any better. You're getting, it's getting eaten away every day with inflation. So you've got to do something. And where are you going to go? Where are you going to get value? Well, real value in these mining companies is already apparent. The discoveries and the money that's gone in is there. So, in these, for sure, the broader macro trend of electrification is not going away. Doesn't matter what recession does to us. There's still going to be more EVs sold next year than this year, and the year after that, and the year after that. So it's like, get behind a major trend, and look for a big win.
Well, valuations are just so stupid. I think we have a really easy case on valuation, but I think our market cap right now is anywhere around 25 million. We have 20 royalties, right? One of our royalties, it's on Battery Hill. It's really one of 2 manganese districts, all in North America. That could be a domestic source of supply. China dominated that market. Produced 99% plus, of manganese for the EV space as of 18 months ago. So we got 1 of 2 domestically. They put out a PEA, 47-year mine life. Going to pay us anywhere from 3.5 to kind of $5 million US a year. That's over 200 million, US in cash flows. That's 1 of 20 royalties that we have, and it costs us nothing, right? Those cash flows, we have no operating costs on those. We're not responsible for capital costs. It's just a timing thing. That's 1 royalty of 20. I wouldn't even say it's necessarily our best royalty. But so where we're trading at right now, I think it's just absolutely nuts. But you see that kind of valuation right now across the sector. It's just crazy.
But that's the point here. People are very, very nervous and not quite sure what they need to be looking at. And hence the point of this conversation, which is, be contrarian. But to be contrarian, you need to understand how a contrarian thinks. Like, for instance, Joe, you understand. You said you understand why people are nervous. Why aren't you nervous? Or maybe you are, but I assume you're not.
Do I look nervous, Matt? No, I'm not.
You don't. That's why I got you on here.
So it's a very important point. And what's interesting about what Terry just said is he's backing the truck up now and going to existing shareholders to fund the company. Lepidico launched an entitlements offer at the beginning of last week. It is looking like it's going to be an extremely successful offer. The stock is 20% above the offer price. And we're seeing there's a renounceable issue. So we're seeing the rights trade. They're trading extremely buoyantly. And we've done, to your point about being in a bear market, we were in a bear market in the lithium space for 3 years. Every year we were raising money year in, year out to deliver on our strategy. And it was tough raising money in those years. Yeah, we always managed to deliver an oversubscribed issue. And I've got no doubt that our underwriter will deliver an oversubscribed issue this time. So the companies, like Terry's company's doing it, Lepidico's doing it. The companies are providing leadership. We're funding these things ourselves. That's the time to be getting in.
I think and I love what both these guys are doing. That's something that we've looked at too. I'm sure they've had bankers that are saying, hey, we'd love to finance you. But right now, honestly, I never said, no to that more than anything right now. Now it's, if anybody's going to be getting in, it's going to be our own shareholders, that have the opportunity.
And you invest now and you take up your entitlements. It's non-dilutive. You're not being diluted.
Exactly.
But you're seeing that a lot more. We're so staunch about where things are right now that it's really only the investors that are with us today. Do you want to even give the opportunity to keep getting in? Otherwise, you're going to have to buy in the open market.
Right. So let's go through an exercise and actually work out what people should be looking at. Okay, the kind of confidence when you're talking in Terry's case, he's saying, well, if the market doesn't want it, we're definitely taking it because we know how good this thing is or how good this thing that could be. Joe, the rights offer it's indicative. So that's one way of looking at this. How else should people looking into companies broadly? What should they be focused on? What's important and what's not? What's real and what's just noise?
I think Brendan made a good point, with respect to, say, for example, his royalty business. I mean, their burn rate is quite different than a burn rate for, say, Joe's company or my company. And so I think companies, if you're an investor, look at, burn rates and, okay, how feasible is it for these guys to get to cash flow? Because ultimately, every business either gets to cash flow or to sell to somebody that's going to get it to cash flow. Otherwise, you're not going to, exit properly. So, that's, I think in obviously Brendan can speak for his own case, but obviously he's made the investment, so he'll just wait until that starts to come in. For Power Nickel, the neat thing about the nickel space is that we're going to be at a stage where we're already getting calls from lots of major industry players, the who's who of the industry, both on the consumer and on the industrial side, that want to do a deal. They want in because North American nickel is going to be the prettiest girl at the ball. If you want to sell an EV vehicle in North America, you're going to have North American nickel, and there's just not that much of it. And there's not, and there is, as Brendan said, it takes a long bloody time to find it and to get it in production. So good luck. So that's the difference is look at companies that are going to be able to get in production. It sounds like Joe is already there and expanding and has a new technology. So, I mean, that's the prize here is that there's so many great assets that are like so obvious. We're not talking about, hey, I think I might get a hot hole here, and baby needs new shoes. This is like, it's already been found, probably 99% de-risked, and you can get 10, maybe 100 times your money. It's like, get off your wallet, find the courage to invest, really.
Yeah, well, look, I appreciate, Terry, that on the G&A. I mean, our burn is so low. We could theoretically right now just hold down the fort. We look to be, cash flow positive next year. The nice thing about a royalty company, we have 20 assets. All of those are being advanced by other parties at no cost to us. And when they get in production, our actual operating cost on a unit basis is zero, right? So, we're really protected against capital cost inflation, operating cost inflation, and it's really just a matter of time. That's really the big debate right now is, do we even spend capital given our current valuation? Because if we were just to wait here 5 years, the cash flows that we expect, in the company, I'm not going to even say the multiple because I'll probably get in trouble. It seems outrageous, but to Terry's point, the opportunities right now, are there to make, really, really good returns. But he's got groups that are the majors already talking to him, looking to him, because they have that technical know-how. They've seen what else is out there in the market. I think right now, all of us right here are acquisition targets, whether it's private equity groups or majors or, the royalty groups, for us. But the groups that really know, it's going to be hard for them to hold back, I think, at these valuations.
Well, and that's a really good point there, Brendan, because where the private equity groups, I think, are going to have the benefit versus these nervous people that you're talking about, Matt, on the street, is they will be looking at fundamentals long-term for prices. And they've probably got in their model, and I'll talk to lithium because it's what I know best, but they're probably going to be looking at this market staying in fundamental deficit right through the balance of this decade, through the next decade. And that is going to drive sustained elevated pricing. What you see most commentators doing is mean reverting those prices over the balance of this decade. And that just massively attenuates value. and it creates nervousness. As soon as people on the street see that price curve pulling back, which has no fundamental basis, it's just a mean reversion, it drives concern and caution. And that's where the professional investors, the private equity guys that are thinking 10, 20 years out will be making their returns.
Absolutely. And I mean, I think one of the other challenges that, projects face these days is just how much capital do you need to get in business? I would not want to be, with due respect to the exploration business, because we're obviously still in it, but, it's tough to raise exploration capital right now. It's really tough. I know a lot of good projects that, but they're just so far away from being de-risked enough to really sort of catch fire. So those are the ones that are going to suffer. Now, in the long run, eventually that'll get fired up too. But I think, the key is to see projects that have a pathway to commercialization or are commercialized. And that's where, if I'm an investor today, like Terry's investing, in other things other than power nickel, but I'm putting it in those types of business just because I feel that they're going to be first guys to rise into this current morass that we're in.
But isn't that the problem? That the white noise, lots of companies say we have a path through to production. Right?
There's a lot of promotion out there.
There's a lot of promotion out there. But you've got to say, well, I can look at the following ratios. I can look at the following, assets. I can look at the management statements over the last 3 years. Have they always done what they said? Those sorts of things. And you can say, I'm going to apply my own risk profile to this as to whether or not it can. But I want from you guys to say, well, what are those things that people need to be looking at to be able to judge who will and who won't? Because most won't.
It's tough,
it's just the
right?
nature
I think
of the
it's
business,
tough.
right?
I think there is a bit of a new dynamic. It's not like gold mines, where there's gold mines everywhere. You don't really necessarily need that gold mine over there or there to be in production. I think when you look at, our strategy, really securing royalties on those deposits, North America, Europe, Australia, that could be domestic source supply of these metals, the 9 clean energy metals that we target, moving forward. And I think when you look at the actual supply side from, that perspective, there's not very many out there, but mining's tough. All of us up here have, 10 plus years experience, looking at projects, analyzing projects. There's metallurgy involved, there's geology involved. There's probably 100 different hurdles that you could stumble over in terms of development. Our company, we were kind of custom built actually for generalists looking to get exposure to this space, because we're diversified across all these assets. We're kind of off the hook, for development costs, capital costs, that type of thing. But what we look for, is really projects like Terry said, that have a reasonable path to production, right? Not some mega project, in the middle of the Amazon, or that's got some 2.5 or 3.5 billion capital cost, associated with it. Something that, is reasonable to put in production. You just got a smaller profile, an underground mine, I think is always going to have a little bit of a benefit from an environmental point of view. And jurisdiction, obviously, being something that would be a key risk. But there's a lot of stuff. It is difficult, for investors, especially investors that are not used to looking at the mining space, to really kind of come in and make individual bets on individual companies, and individual commodities. It's a tough place to be.
Right, and I agree with all of that. And those are some of the stock things that you look at. But what I want to get out of you guys is and try and understand it, because you're in industry, you have conversations, and most of my learnings, the best learnings I have of off camera when we've finished filming, because you guys know what the heck is going on, what's real and what's not. But I'm trying to work out which companies, because all stocks are off. They've been hammered. All stocks have been hammered. Everyone's in the same boat. But some are what I would call discounted, i.e. they've come into the cycle and they will cycle out of the cycle, and they will capture that value again and go beyond. Some, quite frankly, it feels to me, have been, they need to kind of backfill some of the gains that they've had previously, because I don't think they've got as much as they would like us to believe, or the future doesn't look quite as rosy. So how do we work out which are genuine winners and players not also runs. Terry.
The thing that I look at is I look at catalysts. Okay, what are the catalysts that are coming for these companies in the coming 6 to 12 months, and are they financed to execute through the catalysts? And then it's like, okay, what will this catalyst do for them? Will it be manifestly de-risk it? Will it manifestly expand the deposit? And then if it does, then I have a reason to believe there's a reason to get revalued here. Because if you're already undervalued, but you're not doing anything, good luck trying to get attention. It's just not going to happen. You'll have to wait for the tide to raise all boats, and that's coming too, but it's not coming tomorrow. So you better have some catalysts, in your plan that are achievable, executable, and they do manifestly create value. That's how you're going to get noticed in this market. And so if you're an investor, got to look for those companies. And those are the questions you got to ask.
So two common words used between what Brendan's just said and what Terry's just said: risk and plan. I read plan as strategy. So companies that have a coherent strategy and they've been sticking to that strategy. Like we put our first strategy in place for our project back in 2016. And we've been through our first 5-year strategic plan. We've just put in a second strategic plan in place just recently. And it's almost unchanged. So we know where we want to go. We know how we're going to get there. We've got the team to be able to do it. So team and leadership is another vital component in all this. And then how do you go about managing risk? And I think for the investor, risk has kind of changed in our space, or evolved, shall we say, in our space quite significantly over the last couple of years. Permitting and approvals risk has elevated significantly. The challenges thrown up by environmental and social compliance has also got more onerous. And what we've done over the last few years is get ticks in all of those boxes. So we've got a fully permitted project ready, shovel ready in Namibia. It's ready to go. Yeah. In Abu Dhabi, we're as far as we possibly can be evolved with our permitting and approvals under the very prescribed processes that they have for building these chemical plant or building any kind of plant within an industrial park. So permits and approvals essential. Earlier stage projects, who knows, particularly if they're in remote regions, etc. Even in some of some developed countries, obviously permitting and approvals is getting more challenging as well. And then the ESG side of things is, I think, for some projects, some strategies, an unknown. Like we put an awful lot of time and effort into those elements, and one of the reasons why we've got the US government's International Development Finance Corporation evaluating the debt for our upstream part of our project is because we've got such good environmental credentials. So what we're doing is we're trying to secure some of the hardest money on the planet to get and jump through all of those ESG hoops, because that then demonstrates leadership in lending, which then provides confidence to all other investors who are going to be coming in and funding this project.
That is really tough money. Coming from a project financing background, there's a lot of hoops that you have to jump through to get that money.
Well, we're nearly at the last one.
Yeah, well, look, catalysts. I mean, if you're looking at what are the catalysts for us, I mean, Royalty Company has a little bit of a, I'd say an extra benefit in this regard. But we've had, nearly 40 catalysts this year. Across 13, 14 assets. And it costs us nothing. And we've got a lot of that coming forward in 2023. And it's funny for how much, discussion goes around all these clean energy metals. I mean, we've got a royalty on a lithium asset. It's going to really be the only producing lithium mine in Canada next year. And, they're fully funded to do that, go into production. That's going to be a big catalyst for us. But, only the second producing lithium mine in all of North America, for all the talk and all the companies out there. The number of groups actually getting to cash flow or, getting into production is, fairly minimal. So for those opportunities that do have a path forward and you can see that, those are the ones that are going to have the biggest upside for sure.
Brendan, this one specifically for you, okay, because of the royalty component, which is in markets like this, it can be difficult for companies to get money. Royalty companies going to step into the breach. That's what they originally sort of set up to do, take advantage of these kind of quiet markets. So shouldn't you be going out there and getting capital and doing deals at the moment? Because there are a lot of cash stranded companies, or is it a case of there's not that many good ones?
No, look, we've got a really good pipeline of opportunities. It's not an infinite amount because the supply side.
He doesn't steal from himself.
Yeah. So the supply side is really weak, really across all these metals. But there are good opportunities. We'd love to do it. For us, it's about finding a creative way to finance ourselves, at these prices, because we've already got a very good portfolio of 20 royalties. Any dilution that we take on dilutes that as well. But there's very wealthy family offices that have, been approaching us. Some of the smartest, best money on the planet, biggest money on the planet, sees this opportunity. And so, it's really about trying to, align that in a way that works with public market valuations, as they are for a junior company, which is a tough spot to be in, especially right now.
And Terry, with regards to obviously the nickel's been through a bit of a run this year, and there are signs this week that China's waking up a little bit. What does that do for you? How much heavy lifting does price do for you in the nickel market?
You know what? It doesn't really do a lot, honestly. It maybe creates some attention, but it's minimal in my view. I mean, we used I think $8 a pound for our 43-101. I mean, some guys have used 960 or whatever, but but generally the market hasn't really priced that in yet, and so that would be the only way it would really impact us. So it's sort of all that fanfare with the London Metals Exchange and all that. That was just noise, really. It didn't. I mean, it was crazy, ridiculous how it unfolded, but it was premature. Nickel's definitely in a fantastic bull curve, as is lithium, as is pretty much anything in the battery metal space. But from the day-to-day pricing, it doesn't really matter because we're not producing.
Okay, right. I kind of want to wrap it up now because there's been lots of sort of ideas and thoughts in there, but just want to give each of you a couple of minutes and persuade me why I should become a contrarian investor, why I should look at each of your companies as a discounted stock, which is, significantly better than it was, say, a year ago, but has for whatever reason been discounted by the market. Why should I be buying your stuff, Joe?
So we're right on the cusp now of being able to make a final investment decision for this project. So we've been talking about catalysts a number of times here. So over the course of the next 4 to 6 months, there are going to be key catalysts that are going to allow us to transition this project from the front-end engineering and design phase that we're kind of wrapping up right now through into a final investment decision. And then we're in full construction and production is on the horizon. And so being able to capture these elevated lithium prices, and when I say elevated, spot prices are currently sort of plus $70,000 a ton. My sense is what we're going to do is see elevated prices right the way through this decade, well through into the next decade. And that's what most commentators are missing because they are, as I mentioned earlier, mean reverting. So I think you get in now when the market's obviously a bit jittery. It provides a fantastic entry point. And as I say, we're raising money right now. And one of the things that we've said to our shareholders, this could be the last capital raising before we come into production. So This is your last opportunity.
Good. Well, first of all, congratulations on what you've done so far, but also for the use of attenuated and capitulatory. Great vocabulary. Brandon, I'm going to give the same question for you. Why do people need to launch into your product?
Yeah, well, look, this would be the time. The valuation's absolutely just nuts. We've got 20 royalties. Those are royalties on, really the best clean energy metal deposits in North America, Europe, and Australia. I think there's a big push for domestic source supply for these metals. And, we're expecting to be just kind of like Joe, cash flow positive, hopefully next year. And this could be the last, it might not be another future financing for us because, we won't need to. All of the work has been done by third parties, over 400 million raised and investing in our assets over the last 18 months. And so, all that work is going to be funded by third parties, and, cash flow is coming back to us. But, where we are today, like I said, one of our royalties we're expecting over the life of mine be over 200 million in cash flow. That's one of 20 royalties. And, today we're about a $25 million company. So, I think smart money is going to be definitely coming around and looking at us. Retail money should definitely try and beat them to the punch.
And Terry, you're about to start a drill program. So again, why should people be diving into your project?
Yeah, I think it's really simple. We're getting paid about 10 cents a pound of nickel in the ground. A commercial project like that, or one that is perceived as being commercial, like Talon Metals, is getting $1.20. So when you go from, in the ground potential to being commercial, there's a 10, 12-fold jump there. And then it's like, in order to get commercial, you have to triple what you got. So 10 times 3 is 30. Well, if 30x doesn't get you off your wallet, I don't know what will. So, I don't know what more can say. And by the way, we've backed up the truck. The shareholders are buying it right now. And we've always said this. We said, hey, we will buy it if you guys don't buy it. And here we are. So it's like, I don't know what more you can say. It's like, and the neat thing about nickel is this will probably be we'll obviously need to raise more capital, but very likely our next capital raise will be with a strategic partner. And that will, because we're junior and it's like, you guys haven't done this before and blah, blah, blah. Once you partner with somebody big on the consumption or in the industrial side, they sort of say, well, those guys are actually intelligent. These guys must be actually telling the truth, So there's that, So we get that. I get that. But anyway, that's what's coming for us.
Okay. Well, I'm Joe Walsh, MD of Lepidico, Brendan Yurik, CEO of Electric Royalties, and Terry Lynch, CEO of Power Nickel. If you like what you heard today, and go and have a little look at their companies. You can watch a backdated series of videos that we've done with the guys. And if it makes sense to you, why not go and have a little tickle? Thank you, gentlemen.
Thank you, Matt.
Thanks.
Bye.